From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, August 27th. You're listening to the Macrocast. This is Tony Fratto from Hamilton Place Strategies. We have John Fagan and Brendan Walsh with Markets Policy Partners with us, as always, here on the Macrocast. And guys, we had a date that we've had marked on the calendar for a long time, which was the annual Kansas City Fed Monetary Policy Symposium at Jackson Hole, Wyoming, with no one in, I guess there's some people in Jackson Hole, right? But
yeah.
Chairman Powell delivered his remarks today remotely, and maybe made a little bit of news. I mean, pretty straight review of what we've known about how he thinks about the economy, but we've got some clues on the timeline. Brendan, how did you see it?
I would describe this speech as he set the tone for a dovish taper. So he said, if the economy is good, I think it would warrant us beginning the taper process later in the year. But he also kind of made it clear he really would like to see, at a minimum, the September jobs number. And if it's not great, then he probably wants to see October. So that puts the announcement probably at the earliest, really, in November, that November meeting. And on the inflation front, he basically feels like he was right about the inflation, that the big spike was transitory. And we actually got the PCE inflation data today, and it is coming down. The core was 0.3, which is kind of in the range of normality. It's usually on a month-over-month basis, somewhere between 0.1 and 0.3. So there was nothing hugely troubling. And actually, the largest contributors to that was still, hotels were a big contributor, which also will start to come down, and transportation, gasoline, things like that. So he feels good on the inflation front, and he's focused on the employment front. And honestly, we're just going to have to wait and see how that goes the next few months, especially with the Delta, which he, for the first time, addressed that could be a problem. John, how's the market taking it?
Yeah, it was a classic reaction in the markets to a dovish Fed communication. Really, you saw the treasuries not do that much. I mean, honestly, treasury markets, you got the yields come down a little bit, but they've been sort of anticipating this. It's sniffed it out. The dollar is coming down, came down on his remarks, and equities popped higher. It's a very classic formulation of it really wasn't unexpected. It wasn't a dovish surprise by any stretch of the imagination. It was more just taking some of the uncertainty of a potential hawkish tilt by Fed Chair Powell off the table.
And also, basically, every other Fed president that spoke this week was quite hawkish.
Yeah, we saw the regional Fed presidents particularly really have a drumbeat of hawkishness in the lead up to this. And the way that we've sort of looked at that was they know full well that Fed Chair Powell was going to step up to the tee and hit it right down the fairway. And so they were trying to air their dissent in public, and they have certainly advocated forcefully for a taper starting in the September meeting, an announcement in the September meeting, and a start for the taper in October. But Fed Chair Powell has certainly not committed to that approach.
Yeah, and Powell, in a nice way, said, I really like you guys. I enjoy your company, but I'm in charge.
He's just not buying their inflation risk story. He's not buying it. He pushed back very forcefully against that in his speech. He's done that in the past, and he continues to do it, citing specific data and signs that inflation pressures are moderating underneath the distortions. He highlighted the risks of tightening too soon, and basically, acknowledging that once you start, you really can't, you can't really give it back. Some of the hawkish members, like Fed Chair Bullard and like St. Louis Fed President Bullard and some of the others say, well, if you start and things start to get worse, then you just stop. Well, that's not really optimal Fed policy from the perspective of the chair. So it was very much the split on the
That's
committee.
That's what the CDC does, not the Fed.
Yeah, the split on the committee was ever more stark over the past few days, but the core of the committee seems to be holding the line.
On inflation, I thought, Chairman, he actually like numbered his arguments, right? Went through them.
Yeah.
It was clear that he's not seeing broad-based inflation pressures, so he's seeing acute inflation, but broad-based, as John mentioned, moderating inflation in some of the areas where we have seen high inflation in the first half of this year have moderated and come down. He said he's not seeing it in he's seen some broad-based wage increases, which he sees as consistent with their long-run inflation expectation, wage gains at rates that they would like to see. So not a worrying level at this point. And then modest long-term inflation expectations, that market participants seem to have confidence that we're not going to see, if we runaway inflation for long, if we have it at all, we're not going to see it for long, and that the Fed has the tools. So, it was a pretty, I thought, strong argument for his case to be data dependent going forward.
The only slight criticisms that I would have is on the inflation front, where they have stated that they want to raise the level inflation above that 2%. It kind of seems like he's backing away from it a little bit, where he's like, we've met it, but we're going back to where we were. And instead of trying to push it to that next higher level.
It's with all the distortions that are going on in inflation, it's really hard to get that baseline reading. And Chicago Fed President Evans was talking earlier in the month about his concerns that just what you said, Brendan, which is that the Fed is insufficiently committed or has insufficient visibility on achieving that higher plane of inflation. And that was something that we've talked about in the past. They don't want to go back to the status quo ante in the inflation realm. That was too low. They've been missing their objective
for 20 years. We've been in 1.5% to 2% core PCE, and we very rarely ever go above 2%.
One of the data points that he talked about, as you mentioned earlier, Brendan, was on jobs, and he noted that job creation has averaged, I think he said 830,000 roughly over the past 3 months, which is, pretty strong. I don't know what expectations are, what we're seeing right now for the August report. But what is it? And it got me thinking. So that's those are great numbers. That's exactly what you want to see, what you hope to see. What is the number that confirms for him, and what is the number that disappoints for him? Right, and I don't know the answer to that.
Right, because we're still about 6 million jobs short, or 7 maybe of where we should have been if we didn't go through this pandemic. Yeah. So again, like 1 million jobs is an amazing number, but that gets you 1/6 of the way to where you're supposed to be. And it takes a half a year to get there if you're 1 million. So I kind of view 1 million jobs a month as a little bit disappointing.
Fed Chair Powell,
it's not bad, but I would rather it be 2 million.
Well, I felt like they got to that level later than I expected. I thought we were. I
agree. Yeah.
I thought we were going to be higher faster. Yeah.
Yeah. But also to your question, I don't know what that answer, because it's so unprecedented that big numbers don't mean what they normally would have meant.
Right. So so if we average, still an amazing, $500,000 or $600,000 jobs a month over.
That's a year before we get to where we're supposed to be.
Of the year, do we say that's good enough, or is that not good enough?
In my opinion, it's not good enough. Right.
Well, certainly not for QE. Maybe tapering.
For tapering, it couldn't be good enough, but it certainly pushes any talk about a rate hike well into 2023.
And Fed Chair Powell again referenced the more impacted socioeconomic and races, race categories that have been hit hardest and have a lot more ground to make up. and are still lagging in some of the improvements. So that's a theme that we've seen the doves hang their hats on again and again, and it's salient.
Yeah, I mean, it's for all of the people who have been pretty loud over the past month or two on the concerns over runaway inflation, the costs of inflation. I have not heard them answer that question. What do you do about the fact that we've got a two-track economy here, where a huge part of the economy is doing really, really well, and they happen to be mostly white people, and parts of the economy are not doing really well, and they happen to not be white people, and they're people in lower income groups. And his point, his basic point on this is that we'd rather run hot longer until we can pull those lower socioeconomic, hardest hit portions of the population and pull them back into the workforce, which just reminds me that he has made, you could agree with him or disagree with him. He's made the strongest argument on that kind of attention of any Fed chairman that in my memory. And which is just mind-boggling why these, like some of the some of the criticisms of people who don't want Biden to some progressives who don't want to reappoint him. It's like he's made your argument better than any of you ever have.
Ever. And that's and Congress gave the Fed a dual mandate: inflation and employment. You as a governor don't get to choose which one's more important, and they clearly have not met the employment. You don't have to be a math genius to figure that one out.
It is one of the things that, just as a side note, in Wall Street, you really don't talk so much about the personnel decisions, but in Washington, D.C., you definitely do. It's all very political, everything is seen through a political lens. And so just like when Democrats were talking to us during the Trump era, when Fed Chair Powell was engaged in a vigorous easing campaign, there was a lot of discussion about, is he easing just because Trump is blowing him up on Twitter? And now you talk with people on Capitol Hill that swim in the political waters, and they see it as, hey, this guy's trying to keep his job. And so he's not going to do any tightening before he gets reappointed. And so it's, there are lots of motives ascribed, and I think you got to take that with a grain of salt, but it's certainly in the atmosphere down here in DC.
Very much so. Yeah. What else from any of did you guys pay attention to much else from, I didn't get a chance to dive deeper into the papers or talks at Jackson Hole. Have you guys seen anything else that caught your interest?
It really is just getting going now. So there hasn't been a huge amount other than the Powell speech in terms of massively interesting papers or anything like that.
Yeah.
There was a very interesting op-ed from Larry Summers.
Yes, this is probably
yesterday,
the most thing.
Where he fired another broadside against the Fed and has cemented himself as like the leading critic of the Biden administration.
Yeah. His behavior has been very strange the last year.
I haven't discussed this with Larry, but I'm going to say that Larry is doing his best to make sure Powell does get reappointed by Democrat administration. I
think that's a good observation.
I don't think that's true, but it would be that it's a good story though.
Yeah. The op-ed is very interesting. I mean, the title is, it's time for the Fed to rethink quantitative easing. What the op-ed actually says is it's time for the Fed to end quantitative easing. But he alludes to it in his final, he makes 3 points, and the third of which is QE is a policy that exacerbates inequality by boosting asset prices. And so it's really not the best way to inject liquidity into the economy to create real economic activity. And that, I think, is, I don't want it to get lost in the shuffle. That's a really salient point, and the Fed is talking about it themselves. And hopefully once the taper is already in train and we're past the Delta wave and vaccination rates are going up and we're approaching more normalcy, both in the policy and the public health side of things, the Fed will take a look at that kind of line of inquiry and think about, if there is a better way to get liquidity into to stimulate real economic activity in a variety of economic strategies.
Well, the pandemic has given us a data point that's interesting. Actually, just giving people money, it worked pretty well.
Works pretty well, yeah. I agree with Larry on that. I mean, the problem is, you get to the question of, well, so then what, right? And what is,
that's the important point.
The money, you should use fiscal tools in order to fix those, because you can target them better. You can help the right people without getting the distortions. And that's a fair point if you think that's actually going to happen in ways that are sufficient for pulling those ways. And I think Larry thinks so. I mean, Larry's also talked about the size of the spending packages also. Yep. Which are targeted more towards, helping populations that could use that support, participate in the economy. So it's, I think he's consistent. I think he's making his argument, but he's also, I'd rather have Larry's voice out there, challenging thinking on this than some of the other, stupid attacks I've seen.
Yeah, and the part about the taper, it annoys me. It's a lot of the people that don't approve of QE. So that's fine. You can think it's not a good thing, but that doesn't then lead to we should taper. That's a completely different decision. We have it. Now we have to decide what's the best policy action for that. Just because you don't like it doesn't mean we should get rid of it right away.
I agree.
Actually, before we take a break, I have a trivia question. Who was the first United States president born in the United States? We'll tell you the answer at the end of the podcast.
Love it. You're listening to the Macrocast. We'll be right back.
Our Associates and Analysts application is open. We are looking for current college seniors interested in economics, political science, or public policy to join us for a 2-year leadership program with start dates in January, June, and September 2022. Apply today and work on the top debates and policy issues in tech, healthcare, energy, trade, and more. You can apply by visiting the careers page on our website at hamiltonplacestrategies.com/careers.
All right, back on the Macrocast. We will have the answer to that trivia question at the end of this segment. John, what's going on with oil and OPEC right now? It's something I feel like we have to keep an eye on.
Yeah, oil prices have been on kind of a wild ride, and over the last couple of weeks. And this is only a wild ride relative to where they've been over the past year, which is far more tame than almost every other commodity you can name. When you think about commodities markets in the post-pandemic or the late pandemic era, it's been crazy. You have all-time highs in so many different metals and bottlenecks and supply problems, and soaring prices of agricultural goods, and you name it. Everybody's been aware of the insane lumber prices. Steel prices are shooting the moon, and so on and so forth. But the main event for commodities tends to be oil, and oil has gone up to multi-year highs, but hardly the eye-watering heights of a lot of other markets, and certainly the supply constraints that have been impacting oil prices and helping support them have been engineered by the cartel OPEC and its ally Russia. This is a policy that they put in place in the depths of the pandemic. We all remember when WTI contracts went negative, and these collapses in oil prices and so forth. And so OPEC got a round of applause for very swift action led by the Saudi delegation, and pulling massive amounts of supply off the market and enforcing discipline, even as the recovery got far more developed. And they've just begun this year to start pulling some of these, start rolling off some of the constraints. And it's a process, and they've still got quite a few. They've got quite a few barrels set to come back on the market. And the Biden administration, as the summer driving period put gasoline prices high, put a public letter out there exhorting OPEC to start pumping more. they've got a decision next week about whether to do their scheduled additional 400,000 barrels per day additional supply in September. And this is something that, given the price declines that we saw in the past week or couple of weeks, there's speculation that they may cut that in half or have some other kind of moderation of the additional supply as they see the Delta variant playing out. And this is something that's helped support oil prices this week. We did see oil prices come down to sort of a multi-month low. But again, these have been basically range bound. So the oil prices haven't been all that impactful of an inflation story. They haven't been driving market risks to the upside and the downside. It's actually been kind of a Goldilocks trading range that we've had. The current levels around like high 70s. We achieved those in Brent crude like in March. And so it got a little bit higher, around 75, and then it came down to about 65, and it's been basically rebounding in that range. So there's really with the prices caught between these forces with, obviously the recovery, and Delta has given us a little bit of a divot in that pace of recovery, but the recovery in train, clearly the demand picture is on the positive side. On the negative side is, as the demand is improving, OPEC is slowly getting more and more barrels to market. We're beginning to see, and there's also, not risk, but there's a possibility of more supply coming from Iran if there's some détente on that side and so forth. So the supply and demand push-pull, it's really kept oil within a pretty tight range. And oil prices, as I said, haven't really contributed the way some other commodities have to this inflation scare that we had earlier in the year.
Yeah, it's funny, because I my economics training wants me to, hate cartels of any kind, right? And I'm still going to hate them, but I can't say that they haven't. They've actually helped manage this market decently well over the past years through some pretty big challenges. And I agree, we're not seeing, we haven't seen the wild moves in energy prices that you would have expected to see. And so you have to give some credit to that they've been somewhat responsible, despite the angry letters from the Biden administration. It seems like it's been a much more predictable market.
Yeah, it certainly it really has been, in a different era, you'd call it Goldilocks kind of prices, favorable for producers around the world. You can basically find so many profitable parts of the oil industry at like $70 a barrel. It's a lot of the shale patch and oil sands and that sort of stuff is profitable or tends to be profitable around that kind of level. We are seeing a pickup in U.S. production slowly off of the lows of the pandemic era. Not nearly the heights that we saw in years past, but
that part surprised me a little bit about the how slow the shale patch guys have meant to come back. I guess they've kind of learned over the years. the weak hands are bankrupt, so now it's a much more sophisticated group of drillers.
Yeah,
that's what the Saudi energy minister has said about the U.S. supply picture, which is there's more discipline baked into the industry now. Maybe that's true. Maybe it isn't. Maybe it's just impingement with. They're having a hard time getting workers and trucking and all of the bottlenecks. Yep. All these logistical bottlenecks really are pinching the shale patch as well. I think there's no doubt about that. And so we'll see. We'll see if they're sort of born again rational producers in the shale patch. But time will tell.
Time will tell. We'll find out. And next week, what do we got? We have jobs next week.
It's Jobs Friday. Yep. So it's a busy week for data, but all the other data doesn't really matter.
Yeah, this is going to be a really big number. I mean, not a really important number.
Number. We hope it's big.
John, do you have what the consensus is looking at?
Nearly 800,000 is the
800,
consensus. Just slightly under that, and that's not that different than the previous few months.
Right. Yeah.
Below. But this is also the time we've been talking about the impending roll off of the augmented unemployment benefits. That's still actually in the future in a lot of places. So we'll see what that brings, and what August looks like.
And extending those is not part of any of the bills. That's
not at all.
It's accepted that it's time to move on, I guess.
Yeah, September, October, back to school, back to work will be really telling. And, we expect the Fed to wait and see if they can get those two additional non-farm payroll numbers under their belt before they make a call on tapering.
And that makes sense. I mean, and honestly, that's why, I want to love to see good numbers, like to see them big. Man, I really don't want to say what I think is, whether we're on track or not on track until I want to see October's numbers, not even just September. I want to see September and October, see it confirmed and see what that looks like. And so to me, that's the big, that big, first Friday after the first Monday in November is the one that I'm really paying attention to.
Yeah. And this isn't really monetary policy. It's just kind of common sense. Like, you've done it this long. Why not just wait another month? It's not that long.
Larry Summers is writing, op-eds every other week,
exactly.
for not tapering.
Well, when you have clearly, we've seen economic data coming in that's really uneven. That's the title of the economic symposium.
Yeah, exactly.
Uneven recovery. And we've seen retail sales look pretty ropey over the last couple of months. The personal spending didn't look particularly exciting that came out this morning. When you look at the GDP nowcasts that the Atlanta Fed and the New York Fed are doing, they're a lot lower in the third quarter, and they're trending in the wrong direction.
Yeah, it's around 5.5% now.
Yeah. Even if you agree that, or even if you think like we do, that the recovery really is on track and that is going to be robust and it's going to get through Delta and in good health and continue to gain traction, you have to acknowledge the elevated level of uncertainty. This is a really pivotal period. And if the Fed were to, say that it's time to taper in September with maybe only, few additional data points behind them, that would raise a lot of questions among market participants about they must be more worried about inflation and asset price bubbles than they're really letting on. And that's a negative kind of connotation for asset prices.
I completely agree. I think that's exactly right. Brendan, who was
Martin Van Buren, 1833.
The Little Magician? Was he the Little Magician? I think that's right. Yeah. That's a good one. Are we gonna make this a weekly feature now?
Yeah, I think we got to do a.
We have to.
Yep.
All right. Love it. All right, guys. Hey, I'm not going to be with you for Jobs Day because I'm going to be in Italy this time.
Oh, exciting!
Week on my late summer vacation. But I'm looking forward to getting away. But I'll tune in and listen to the broadcast. And
we'll have Matt McDonald.
Absolutely. All right, guys. Have an amazing weekend.
You too. A lot of fun.
You too. Bye.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.